First of all, thank you very much for having us. I'm a representative of Angels for Women, which is a network of business angels for women empowerment and for the support of women startups, women-led, let's say, startups. I'm more than happy to be with you, and I encourage any question for any question to raise your hands and to ask on the Q&A. I'll be more than happy to interrupt and answer. So I would really like for this workshop to be as a dialogue. So feel free to ask if there's anything you would like to understand in depth. Let me see. Okay, this is myself. I'm a startup advisor, and I do some seminars and workshops on startups. I work with 2 acceleration programs. One of them is Impact Hub Milan, which is connected with Angels for Women, and the other is Bocconi for Innovation. Bocconi is one of the leading university and MBA superior programs for entrepreneurs. I've been working as a marketing and sales manager in a number of sectors, and I've been managing director of 3 companies. And I've been found in 2 startups. One of them brought me several times in the Middle East because it was a startup for alcohol-free champagne. So I've been visiting Qatar several times. Today, we will be dealing with 2 topics: business angels and angels for women. So who are business angels? Who are the first investors that you will be dealing with when approaching investors, when opening your capital, and how they select a startup? That's the agenda for today. So what are business angels? Business angels are individual, high net worth, with a big working experience, business experience. They used to invest their own funds. So on the opposite of venture capitals, they invest their own money, and they are the best investors for the support at the initial stage of a startup. They know the high risk. So they are very confident with the high level of risk of an early seed startup. And they have no fixed amount on what they invest. So usually they invest in clubs to raise a bigger amount of money. And they are the figure between friends and families and a venture capital. So as we said, they are professional and informal investors. They look for high potential startups, and their goal is a multiplier of 3 to 10 on their investment. So they are very very comfortable even with startups at a lower multiplier compared to venture capitals. How do you engage them? Usually, a business angel wants to be involved in the advisory board or in the board of directors of your company. A possible cooperation is in work for equity. And they usually, as I said, most of the times, business angels work together with other angels, and they elect a deal champion, which is the advisor who's taking care of the relationships with the other investors. Oops, sorry. This is a quote which is really a summary on what is moving a business angel to invest. And it says, when we do an investment, we always ask, can we affect the outcome? When buying a company, can we have an impact? That's a different style of investing than a passive investor in the stock market. To me, that's how you're taking the risk out of it. You know what your capability is and how you can enhance value. What is Angels for Women? We are a business angel group created to foster female entrepreneurship. We are sponsored by AXA Italia. AXA is an insurance multinational company, and partnered with Impact Hub, as I said, the acceleration program and investment program, which is an international network. We invest in women-led startups. We target early stage, ethical sectors with female founders. We have a minimum ticket of 5,000 euro. The investment is not compulsory. We used to invest with a vehicle, which is a company owning the shares. And we have a deal champion among identified among the angels, and Impact Hub as a co-champion. Any question since now? I don't see any questions, so I'm going ahead. What are we now? We are 70 business angels. And how does it work how does it work to cooperate with us? I see probably a question. Thank you, Clear. Thank you. All right. Sorry. Okay. We have a system where you can upload all the materials and do an application to show and to share your project with us. And then we will go through a deal flow scouting and screening. The members will be admitted to a chat room where the other angels will eventually ask questions if anything is needed or not clear. And if we raise a soft commitment for investors to invest in your process, in your project, we will go through the due diligence and investment process. Let me see if there's a question here. No, it's still nada. No other questions, right? Okay. Okay. Sorry. These are some of our partners, and our partners are growing. So we will soon have yourself on board as well. Okay, perfect. So how do business angels and investors select a startup? When you plan to approach investors, it is very, very important for you to to provide a powerful presentation of a need in the market, and to share the right insight, the right description, the right numbers to attract investors. So first of all, you have to show them you know the market, which is current or potential, because we look to we have a 10-year ahead overview. Then you have to show that your innovation fits in the in that market need, and you have to show that the potential market is big enough to build a sustainable and economic business. What do we look for? First of all, we look for an incredible team. because at the beginning, every startup is probably going to pivot, which is changing a little bit their business model a number of times. So when the good idea and a good potential market are identified, the team is what is really making the difference. They have to show that they have technical background, business skills, and experience so that they can execute, eventually pivot if they need, and drive the project to success. The market is the other feature that we look for. What is it? How big is it? And is the idea scalable? We will go through the feature scalable then, because this is a very important topic that investors are looking at. And the idea, to be fundable, the idea has to be disruptive and protected. Let's take a look on what this means. So the idea, a fundable idea is something disruptive, something new, something not existing in the market, or a new way to approach a market and to raise money to gain money from an existing business. So what you have to do is to think new or rethink an existing business from the scratch, and showing, explaining that no one else is doing it, or if this is the case, someone else is doing it, but not like yourself. In this case, it is very useful to show a competitive analysis that is really stressing out the difference between your project and the other existing startups within the sector. Then you have to show that there is a target which is willing to pay for what you are offering. And then how would you monopolize that niche of people, that growing niche of people that are part of the which is the market, basically? How would you monopolize it? So how would you be the main player within that market? Do not fear small numbers, because we are not looking at what the market is now. We look at what it's going to be in 10 years. So if you have evidence that the market is growing, don't feel scared of performing showing small numbers if you have a reasonable trend of growth. This quote is about the team. What type of team are we looking at? Great founders are mission-driven, which is they are completely in love, completely dedicated to their activity, to their business. They have frugality, which means they are very quick. They can do a lot with a small amount of resources, and they have a passion moving them. So the good founders are the people that have ideas all the time, and they are very, very quick to generate hypotheses, to test them, and to implement in new business, in new revenue streams. Again, the market, we have a 5 to 10 years forecast vision. Interesting markets will be big in the future, even though they might look small today. When you pitch, when you introduce your business idea to investors, it is very important that you show the nascency market potential, which is this market, for example, this market is not existing at the moment, but there is a need which is growing. So someone is going to answer this unmet need. Another important factor is the frequency of the use of your product or service. For example, if you launch a new medicine, which is going to be taken daily from the users, this is much different than a medicine taken once a year or once every 10 years. And then find credible adjacencies, which is, I have a service which is dedicated to a small target, but it can be implemented or used in other segments as well. For example, NFT, if you do NFT with masterpieces in arts, you can dedicate the same technology to other segments. The product market fit. This is another very important topic that investors are looking at, which is the identification, again, of an unmet need or a dramatic improvement in an existing industry. When we say dramatic, we really mean dramatic. So it's not a slight little difference, but it's really a completely different way of approaching the market. It is very important at this stage to stress out who is your customer, who's the buying persona. And most of the times we see very effective presentation and pitches that start with a personal presentation, which is, I had tested, I've felt this pain point, so I found the answer. And then you zoom out and you stress out that it's not only yourself, but there is a number of buyer personas having the same need. And then you go to a market analysis to show that a considerable number of customers will be interested in the same product or service. Based on the trends you can observe in the market, if that market is not already existing. Because investors prefer to see a startup focusing on a small niche to better meet the specific needs in a market that has few competitors, increasing the chance of success. Is everything clear since now? I'd like to invite you to ask some questions since now. No questions? Nada. Chat. I see the chat. Let's see. All clear. Okay. No one is asking questions. Okay, let's go ahead. What does scalability mean? Scalability is another key focus an investor has in mind when he looks at your startup. And it is about boosting and increasing the business with a small amount of money. So a scalable startup keeps low development cost when increasing revenues. So they are not growing the same way. In a few words, your business to achieve professional investors has to have the potential to multiply the revenues with a minimal incremental cost. And then we want the idea to be defensible. So when the company's product service cannot be easily copied or replicated or eclipsed by a competing company. I'm reading a few examples. For example, you should have a patent or a license or some rights, like, for example, using rights of a particular know-how. Technology that competitors are not able to replicate are another point for the defensibility of your startup. A large community, which is something that is not easy to approach and to reach. a specific know-how. For example, we are the only guys who can do this. The ecosystem, even having a project which is involving multiple players together is creating value, because it's not easy to involve different players. The brand value, this is only the case of big brands or brands which are absolutely recognized within the community. The timing and the embedding. For example, if you do a software that is really taking care of the customer need, it'll be very tough for him to switch to a competing product. I noticed, for example, there's a number of apps now that are taking care of your passwords. I would never be able to switch to another one because all my all that I need is there. So there's no need for me to switch to another app, even if it's maybe free. And why an investor will pass the investment, so not go for it. He will pass the investment if it is in a sector that has shown poor performance. So if other startups are not performing properly in there, or if it is in a sector that, that has low margins to be made, or if it is in a sector that has a large set of competitors with little differentiation between them, or if the management team is missing key people, or if the product is not working and you have no customer validation. Some investors are investing in a business idea. They will probably ask for a large amount of shares because they take a very big risk. I might have a question. The cost and revenue as comparative basis. Okay, I'm answering the question of Lova by Fatima, which is asking, do you think we need to show the cost and the revenue as a comparative basis, as comparing last year with current against the future cost? So, these are two different questions, two different answers. The competition analysis is not on the numbers, but on the potential and on the revenue streams and the niches where the project is fitting. Numbers are usually at the back, at the end of your pitch. Then, of course, it is important when you pitch, when you work on a business plan, even having the numbers. At this stage, by the way, numbers are not the key topics. Numbers will be fundamental in the future when approaching a venture capital, for example. Business angel and the first investor that you are probably approaching are looking at metrics more than revenues. Conversion metrics, for example, or growing trends. Okay, another question is about sorry. An investor will pass the investment if it is in a sector that is highly commoditized, which is, I mean by this, that a sector which is very well established. So there are little margins for a new player to join. Any other questions? Thank you very much for joining. I'm very happy for you to ask if possible. All right, let's go. How do we evaluate startups when deciding whether to invest? Okay, there are several methods, but mainly two: the instinctual and the quantitative one. At this stage, the instinctual is doing, let's say, 80% of the work, because we already see a number of deals and we hear and see a lot. So we already have a mental picture of average numbers, average size rounds, and the average amount of money that are needed for a company to do a significant step of growth. Of course, the business idea has to fit within the context of the angels group. So, for example, when there are, for example, the network that I'm joining, Angels for Women, is not funding men-led companies, or Angels for Impact, which is another network I'm connected with, is only investing in startups with an impact, a significant social or economical or environmental impact. So when you approach angels, you should find some information on the topics that the club is investing in. So let's the first step is taking a look at your business plan and pitch. So what we do now to give an evaluation is understanding if there are other companies like yours or similar, not necessarily in the same business, who have raised an exit or an M&A. Is it clear? Is it clear what I mean by exit? Do you have a clear understanding on what the exit is? Exit is when you sell the company. Perfect. Or we look at the cost to duplicate. So we estimate that, for example, the app or the tech platform will take a certain amount of time to be developed with a certain number of full stack developers. Or if you have an IP, we estimate the value of the patent or the rights. We look at the metrics, again, more than turnover. So we see how many conversions is your product or service taking from the panel of potential customers, the trends, and our network, because again, we want to invest in companies and startups that we can really empower with our network and with our know-how and expertise. Before the due diligence, we also we can translate the topics that we've seen since now, the idea, the prototype, the team, all these topics that we've been through can be listed and evaluated with the Berkus method. Are you familiar with that? Do you know how the, okay. This method, basically you give a value to the idea, you assign an amount of money if you have an existing prototype, or if it's only an idea, or if it is a beta version already, if it's a technology. The quality of the management, so the team, is another topic. You assign an amount to every to every topic on this list. Then you assign an amount if the company has strategic relationships, because this is reducing the market risk. And even if you have a very clear strategy on how you will sell your product or service. So these are the topics that we evaluate with the Berkus method. Is it clear now? Do you need any other information on it? Not really, I see from Mohammed. Okay, let's go forward. So the takeaways that you should keep in mind about how investors, business angels at this stage select a startup is that startup valuation is more art than science. So when you have very good presentation, excuse me, I have a question. See, can you please elaborate in market risk relationship? What do you mean, Kumash Ahmed? Can you explain better, Kumash Ahmed, what is your question? It's not clear to me what you would like to know. Again, I see a question here, but it's not very clear to me. Can you explain better? You mean here, market? As a key point. Yeah, it is a key point. You're here. So the strategic relationships, for example, I'm a supplier, my product service is a supplier for an airline. So it is a big endorsement. Or I'm cooperating with the biggest football club, for example, and I'm doing clothing. So strategic relationships are reducing the risk for an investor to have someone beating your idea as a competitor. Is it clear now, Kumasha? It's these relationships are what is making the perfect. Thank you. All right. Okay. So the takeaways, we were to the takeaways. So after evaluating everything, even with the most effective formula, we will still have an estimate of a startup because it has no turnover, no numbers to be evaluated like established companies with multipliers. So, and valuation is really based on how much money the founders think they need and how they will spend the money. And it is important for you to keep in mind that with every investment rounds, you are giving away part of your shares because investors are actually buying shares of your company. Other takeaways for you, dream big, but think small. So when you start small and monopolize, which is you become the key player within a market niche, then you scale, then you explore other markets where you can implement your product or service. You are smart enough to avoid competition and you perform, so you have good metrics or a good sales strategy. You will show a believable plan from growing your startup idea to a large and profitable business. This is what investors are really looking at. I thank you very much, and I'm available for any Q&A on your side, on your, I'm available to answer your questions now. I'm opening the Q&A. Thank you very much, Simona. I'm very happy for your feedback. I see a question here. How do you know how much value to add in the Berkus method? It's usually a fixed method. It is a fixed amount that goes from $0 to $500,000. So that's the range for each segment of the Berkus. Let's see if there are. I apologize for my English. I've been doing a number of workshops and seminars, but all in Italian. So my English is not that performing at the moment. I'm sorry for that. I don't know if there are other questions. Maybe Nada. Angels for Women is not investing in verticals. So we are very open and we have very different startups. Sorry, I'm answering to the question of Zahir. I hope I pronounced the your names properly. Okay. She asked what verticals is Angel for Women investing in. So Angels for Women is investing in almost every sector. So what our vertical is women-led startups. We will have chance to see this webinar on YouTube later on. I don't think so.
Let me interpret. Yes, there is a chance to see the webinar on YouTube.
Okay, I didn't know.
Since we are recording everything, they can see it.
Okay, I wasn't aware.
Oh, it's okay.
Okay.
Any other questions?
I don't see other questions. Thank you, Amna. Thank you for the positive feedback. Very happy. It's up to you now. How do I know if there's a big potential in a small company? Okay, this is a very good question. To show a big potential in a company, you have to show market trends. There's no really other way. So, for example, I'm sharing the example of alcohol-free champagne, which is something that you're probably familiar with because there's a number of players there. But 10 years ago, it wasn't like that. So to raise capitals in here, in Europe, I was showing the rising trend of non-drinkers, or those people who are not willing to take alcohol, but still wanting to enjoy something nice and different from a soft drink like a Coca-Cola. And that gave me enough credibility to get some money. Is it clear? Probably yes. I don't see other questions. Okay. It's up to you now, Nada and Stefano. Whatever you would like to talk about, I'm still at your disposal. What are the, I have a question of Yassim. What are the best ways to raise the value of a business? Raise the value. Business value, you mean in terms of turnover or in terms of capital raising? What do you mean? Growing a business or raising capital? Very different. Business valuation, okay. To raise value, maybe I can go back to the slide because this is very helpful. Oops. Okay, this is a very good example on how to show that a market is going to be interesting. So if you show that you are going to reach a very large market and a very large number of customers in a 5 to 10 years time, you will probably be able to get a very big evaluation. Same if your market, if your product, service, and your project is very scalable. I see another question of Reem. What is the best time to put the startup business for investors? Beginning years or later? Well, usually all startups are approaching investors at the initial stage because they need a lot of money to validate. So the best time, we usually recommend 3 different steps. So the, let's say the setup of the company and the first beta test or the minimum viable product should be created with your funds or family and friends funds. After that, when you have some metrics and a clear vision on how to sell your product and how much money you will need, then you can approach business investors, business angel investors. The turnover you should have at this stage is really minimum. It's just needed to show that there is somebody who's interested in purchasing your product or service. Then the second step is when you had some development. So what did you do with the money you raised with angel investors? Then it's the time to approach investors and at the further step, even venture capitals. Okay, I see. What is the main information to be provided on the market analysis? Well, for example, what is your company dealing with? Lova by Fatima. So I'll give you some fashion. Okay, let's say that you are creating pashminas, okay, scarves. You should analyze who else is doing the same, a similar product, how they sell it. So for example, if you're only selling online, you should target and should understand how the others are selling and why a customer will be purchasing yours rather than another one. The pricing of the competitors and yours, the business model, the cooperations that you already have. For example, if you are already in big distribution chains that will give you an endorsement for sure. But probably scarves and pashminas are not a very innovative, let's say, business segment to join. If you provide services for the fashion industry, you should try to understand if someone is doing something similar, or if that need, that particular need you want to fill, is approached by other companies, maybe doing something different. Those might be competitors as well. Is it all clear? Perfect. Other questions that you have? This is a very interesting question. So what would you say to encourage startup founders who are hesitant on trading equity or shares for an early investment? Well, it is a matter of choices. So first of all, startups are not small businesses. So you have to decide whether you want to be a startup or whether you want to build your company. These are two very different approaches. If you want to build your company, you can also have it finance it by debt. For example, you go to the bank and you get a loan. But to do a startup with a very, very high potential, unless you don't have a lot of money to put on it, you have to go through investors. There's no other way, actually. So if you are not willing to sell your equity for investment, of course, the alternative is debt, but the amount of money that you can raise is probably much smaller than the one you can get through via investors. There's also something in the middle, which is the convertibles. So some investors may be open to invest in convertibles, which is, I give you, for example, $1 million, and in 2 years, I may be able to convert it in a 20% shares, or you give it back with 15% on top, for example. This is something very rare. I've seen it maybe one time in years. That's probably the only solution in between. You're very welcome. At what stage is proof of concept vital? It is vital when you approach investors. They want to see something existing, not really making money, but something existing. I don't know networks of investors who are investing in business ideas or theories unless they are in the medical tech. This is the only sector where I've seen something like this, or deep tech. All the rest, it is vital, as you said, Mohammed. Vital is the word, key. Other question? What do you mean, Jassim? When I look to invest in a startup, how important is it for an established business culture to be present? You mean that the team has to be business focused? So the business culture within the startup, or where? You mean the investors have to be aware of the culture of a particular business? For how well formed the team is. So for sure, the investors look at team that have a good knowledge on the field they want to play in. So the importance of the team is focus. You've seen it in my presentation and in the Berkos method. So it is really something that at this stage, it is probably more important than a correct assumption for a working business model, because you can pivot the business model, but the founding team is probably going to stay for a very long time in the startup. So their know-how, but also their soft skills, like, for example, being very flexible, being very smart, being lean, being capable of taking risky decisions. These are all features that are probably even more important than the business idea itself alone. Of course, there is a combination. So the business culture, but not only the business culture, even the features of the founders are very important. You're very welcome, Yassim. Other questions? I have a question for you. What did you expect? Did you get what you expected from this webinar? Was everything clear apart from my English? I have a question about crowdfunding. Thank you again, Yassim. I see a question from Katiba, I think the name is. What do I think about crowdfunding? I did it once. Actually, my first startup was the first Italian startup to complete with a double overfunding 2 crowdfunding campaigns. Crowdfunding is very tough because you have to approach several investors and it's very expensive. So don't think that putting a nice idea online in a portal, in a marketplace, is automatically bringing you money. To approach a crowdfunding campaign, you have to have at least $50,000 soft commitment, which is you have to bring some investment within the crowdfunding campaign, and then you have to promote it properly. So it is something that I recommend at a third stage, let's say. First stage, friends and families, then business angels, and then crowdfunding. You need money to launch a campaign. I hope I replied properly to the question of Katiba. Last question. Okay, perfect. So what are we doing now? I'm asking to Stefano, and what's next? What is the most common mistake startup founders make? First of all, when we receive a business idea and we are asked for a document of not a letter of interest, but I'm missing the word at the moment. You know, when you want an idea to be secret, non-disclosure exactly. When we are approached and receive an NDA, then it's anathematically no, because the network is very professional, and we have the feeling that the companies on the other side are not as professional if they want an NDA when approaching investors. Of course, if you approach your neighbor or investors who are not within a network, then you should ask it. Then another key topic is when we see very, very high pre-seed evaluation. So business ideas, I mean, are generally evaluated maximum 500, $500,000, let's say. Okay, then from at the stage of an MVP, you go up to $1 million, and this is normally when business angels are involved with a pre-money evaluation of 1 million. Is pre-money and post-money evaluation clear to you? Hopefully, yes. Perfect. So these two topics are very bothering, let's say. The pre-money and post-money, you mean, Mohammed? The evaluation, okay. Normally, a pre-money evaluation is what is the value of your company before you received the investment, okay? So just a minute, sorry. So before you receive an investment, let's say your company has a pre-money evaluation of $1 million. You receive 200,000 investment, and your post-money evaluation is 1,200,000. And of course, the shares are diluted, the shares of the founders, because the investors receive some shares. So you have a smaller part of something a little bigger. Is it clear, Mohammed? I think so. Perfect. Any other question? Sure. Okay. No. Yasim, I'm more than happy to, if you have recommendations, suggestions, or questions. I see there's a last question to sum up and to keep in mind for you. Okay. So what are the main tips for people approaching investors? First of all, prepare a very, very smart elevator pitch. So in a very short number of slides, you have to show the problem you're going to solve and how you're going to solve it. So how the best way you do that, the more you get their attention. 10 slides are all you need to introduce a project properly. So the problem, the solution, the target audience, the way you are raising money, the way you are earning money, not raising, sorry. So what is your business model? How are customers paying for your product service? The competition, this is very important, or the market you're entering. And if you have no competition because the innovation is so big that no one else has thought about it, consider in your competitive analysis even other different answers to that topic, the problem that you stress out at the beginning. Talk about the team, the market. So how big will the market be in 5 to 10 years? And how much money you need and what do you need it for? This is all you need to make a very effective pitch to an investor board. If they're interested, they will ask for more information, but this is really what you need, the famous elevator pitch. You know what the elevator pitch is? It means you have to take the time of the elevator going up to the top floor, to the top level. This is all the time you have to explain your project to a potential investor. So you normally have 3 to 5 minutes to explain your project. This is all you need. Be very effective within the description and go straight to the point. These are the main topics that an investor is going to look at. Other questions? Mew?
I think there is one more question in Q&A.
How much should you risk in small companies? You mean how much money? This is a question which is very tough to answer. I mean, an investor might fall in love with an idea and invest $1 million in it, but this is very, very rare. So the best practice is having a deal. It's called club deal, where a group of investors are investing small amounts each. Let's say $10,000 each for a total amount of $100,000. So the risk, normally, professional investors are investing small amounts in many companies. It is very tough for professional investors to invest a big amount in one company. A different approach is that of non-professional investors. So maybe a family friend or someone which is really interested in your business because he has something, he has a business or a company already that might be interested in yours. They might be willing to invest a lot and risk more because they lower the risk by the possible joint venture or M&A that he has already in mind, for example. But normally small amount in many companies. I'm happy for the questions I got because it means that the topic was interesting to you. Probably no other questions. All right.
Oh, okay. Well, if there is no more question, we reached to our end of the webinar.
Okay.
Yeah. Okay. Well, thank you, Ms. Manuela, for the great workshop. We really enjoyed. Personally, I really enjoyed, seriously. And thank you
so
all.
much.
You're most welcome. And thank you all for supporting our event by attending and contributing. We hope you enjoyed the experience and received beneficial information. So hope to see you in our next workshop. Thank you so much. Have a great day.
Thank you. It's been a pleasure. Bye.